Hello traders, this is Dan Hussey from RJO Futures bringing you our end of day recap on the Japanese yen futures. The 6J coming off of an impressive decline and strengthening in the US dollar from highs dating back to June of 2016 to lows of this month here in December. We've had a impressive almost 20% move in the currency cross, and in only 15 weeks in its latest rally, in its sustained rally. So that's one of the historically biggest moves we've ever seen in the Japanese yen, and this is all coming off of course, the U.S. Fed, the FOMC hiking rates here in their December meeting. And it was a rally into that event into December, and tracking closely to what the bond market does, the yen currency holding true to the unwinding, so to speak, of a carry trade that's otherwise been building up for the last 3 decades. So nevertheless, the fundamental picture has been getting clearer and clearer for the yen, with a debt to GDP ratio of over 240% now for Japan. There's no surprise that one of the strongest currencies globally, the dollar right now, has had such an impressive move against globally the weakest currency, the yen. So if this market does decide, and again we're looking at a daily chart here of a continuous contract for the yen futures, if the market does decide to get a sustained rally or a pullback to this trend, full 50% retracements and a potential 93.30 area of resistance as the if the yen does happen to find a bottom here and try to test higher, because this is a very, very impressive move, but at some point there is going to be a nice volatile pop, as there is profit taking against this very sustained trend. Now, that doesn't mean it's going to happen, and that doesn't mean that there is a trade to go long here, because you wouldn't want to catch a falling knife, and that is overwhelmingly going against an unwinding of a 30-year carry trade, a very clear fundamental picture, and then of course smaller time frame technicals that are keeping this trend heading lower. And we'll take a look at some of those potential areas of resistance that we might have into the new year, and some opportunities to potentially trade the yen and hop in on a trend here. So all right, so let's dial down here. Let's switch over to a candle chart and dial down to intraday. Let's start with the 8-hour chart, or if there is a larger full 50%, this market could trade up into the 93.30s. And again, we're not saying it's going there. It's just if we go there from where the point we are here, and we did hold a low, we know that that'd be major resistance. That would just be where the big daily and weekly trend would want to find resistance to keep this market heading lower, which in its cycle, it should continue lower. So backing up for a moment, we can actually just remove that fib from our chart for the time being, and we're going to actually dial in at what has been keeping us going lower. And there's a pretty clear trend line that began going back into mid-November, coming off of the U.S. election here. We began to break lower and just held trendline resistance, throughout from about mid-November through just a week ago, when we finally broke down into below the 8,600 handle. So coming down off the high, I actually draw fibs a little bit differently and a little more creatively than most. I draw at times when we see these kind of breakouts in these runaway markets, and what ultimately looks like cascading price action, right? It's just a series of lower lows and lower highs. This cascading price action can actually be kind of mapped out using a Fibonacci retracement. And what I do is I find a low to a low that actually traded and held a full 50%. Or if you were to draw from a low to a low here in these two, the low from November 16th to the low on November 24th, you actually, and now we can dial down to like a 4-hour chart, just kind of zooming in and taking the trade in, and or where we find resistance in here. We're able to find a 50% line that actually held as resistance. The market did not break above the invalidation area in the 61 to 65% line. And in fact, the market then did also traded from that what would otherwise be the resistance to its downside technical target, which is actually a negative 23.6%. It's kind of an extension. Think of it like an extension tool for the target, but it's all encompassed with how we actually, what levels we actually put on our fib tool here. So again, that full 50% short from the 89.95 area. If sellers from that area found resistance and the market sold off towards the 87.48 support area, and that's where we found our next support. Now, the interesting thing here is what I do next with this fib is actually the next technical trade would be same anchor, and again, remember this went from this technical resistance to its technical target. Right, I go same anchor, leaving the 91.16 or the lows from November 16th. Remember, we drew to the lows on November 24th to find that first 50% short. The next in this pattern would be taking this from low to low. The market never ended up trading all the way back up into the next 50% line, which we would then look for a move from that area down towards its technical target. It didn't even fill that full 50% short, or the next in the series short, as I would call it, and in this pattern. And because it didn't fill that, but it did trade to its target, we now consider this original resistance that held to have now blown out of its target. So that original resistance was so strong that it actually forced the market even lower than where we would have expected it to terminate, or there to have to have been its initial profit taking. So what we do is we actually use that old setup. So I'll bring it back. Remember this original setup, and now I actually draw from a low to a low. This is all getting probably too confusing for most because it might be the first time you've ever seen it, but it's actually how I find our next resistance in this kind of blow away market. And the reason this is important is because it's not just that, okay, there could be a setup and there could be a trading opportunity to sell into a resistance level above us. All right, you could look at this next 50% short as a setup to take, right? Where if we do rally up there, we could take that setup, for a downside target. But the other side of the coin here is actually if the market continues to rally and actually fails the invalidation zone, that actually is a trend reversal and a break of the pattern that we've found on the downside. So you actually have a break in a cycle and a break in an actual like algorithmic structure to how the market's progressing forward. And that type of break, we'll take a look at that if and when it happens in a market, and that'll come down the road. And that's because there is a whole pattern and a structure to the way we look at this. So to add to that original resistance zone, or this new resistance zone we're finding that could exist above into this 86.42, and where there's actually a confluence of fibs. So there's two fibs that line up there, and it's not only the low to low extension short, but it's also an equal legs. And both Elliott wave and whenever you have three wave moves, we look for the two legs to actually be equal to each other. And in this case, if we actually project this first leg from the termination point of that middle or connector leg that tested the downside, it actually takes us to that same 86.42 area in the yen futures. So you now have another fib that gives us yet another kind of confluence level, or a reason that if the market goes there, we may see resistance and continuation lower towards an 83.96. And this is, of course, the most aggressive selling that you'd see on the yen. This is where we'd expect it to be. And most importantly, if we actually break above these levels, we'll start to look for reversal, or maybe even buy a pullback for a much larger reversal. That could take us higher, towards the 89 and even higher still towards, again, if you take that big step back out to the daily, it's up around the 93 area, is the full 50% short of the entire prior decline if you look at that continuation chart. So you'd have to break through this lower, or this most aggressive resistance you'd have to break through this most aggressive resistance here to even begin to consider that type of rally. But as it stands, a nice three-wave move into the 86.42s. As long as you remain below the 87 handle, we're looking for the market to actually probably continue lower into the 83.96 area, which would be your technical downside target. So pretty clean and clear what the short-term technical picture is saying. The fundamental picture hasn't changed. It's still looking for that unwinding of the carry trade and a weakening in the yen. And with the U.S. and the FOMC confirming that we are in fact in a rate rising environment, that helps support the U.S. dollar just from an interest rate perspective. Anyway, so dollar bullish fundamentally, yen bearish fundamentally, and a beautiful looking technical chart. It doesn't get much better than that in terms of trading conditions. So we have a trending market next in the series that we can look for to hold and see if we can't get a reaction off these levels for new lows, and ultimately a fully painted picture of what the yen could be doing. So with that, I'm Dan Hussey from RJO Futures, and I'll be back with you as price action develops.